All right, today we're going to dig into a strategy that really tries to solve a classic investment puzzle. We're talking about the Magnum Hybrid Long-Short Fund. So let's just start with a question that, every investor has probably asked themselves at some point. Is it really possible to find one single investment that plays offense when the market is climbing, but then can switch to defense when things get a little rocky? Can you actually have the best of both worlds? And that question right there gets to the heart of the classic investor's dilemma. It's that constant tug of war between chasing after growth and, at the same time, making sure you're protecting your hard-earned money. I mean, think about it. On one side, you've got the desire for growth. We all want those high returns, right? But that usually means taking on more market risk. And then on the other side, there's that need for safety. But if you play it too safe, you could miss out on the long-term gains that are so crucial for building wealth. It is a really tough balancing act. So, what's the answer? Is there a solution to this dilemma? Well, that's exactly where a hybrid strategy comes into the picture. It's an approach that's specifically designed to find a balance between these two competing goals. And the Magnum Hybrid Long-Short Fund is built on this very idea. At its absolute core, it's an investment strategy that aims to strike a really careful balance between risk and potential return. Okay, but what does hybrid long-short actually mean? Well, it's pretty simple, really. It's a strategy that combines two different approaches. First, it goes long, by investing in things the fund manager thinks will go up in value. And second, it goes short, by taking positions that could actually make money if other specific assets go down in value. A great way to think about this is like a cricket match. You've got your batsmen, that's your offense. These are the long positions, and they're aiming for growth, trying to score runs. But then you have your bowlers and fielders. That's your defense. These are the short positions designed to protect against downturns. This fund is basically trying to build a team that can do both really well. So where does the money actually go? Well, if we look at the fund's allocation, the biggest chunk is in equities. That makes up about 65 to 75%. Then for some stability, about 25 to 35% is in debt and money market instruments. And you'll also see a smaller, more flexible slice for things like real estate and infrastructure investment trusts, or REITs and NVITs, which give you some exposure to big income-generating assets. Okay, let's zoom in a little bit and look at the offense, the part of the strategy that's all about growth. The long positions are really the growth engine of this fund. It invests in stocks that have a strong outlook, trying to capture those gains when the market's rising. But that's not the only way it tries to score. It also uses other strategies to generate income, like arbitrage, profiting from tiny price differences, and covered calls, which can bring in a steady income stream. Now let's flip to the other side of the coin, the defense, which, as you can guess, is all about managing risk. This is where those short positions come into play. See, these are designed to profit if certain stocks or even whole market segments go down. The goal here is to hedge, to protect the main portfolio during a downturn. Now, what's really important to know is that this defensive side is carefully managed. The fund's documents say it's limited to a maximum of 25% of the portfolio, so it's a measured approach. And this visual really brings it all home, doesn't it? You've got the long side in green working to grow your investment, and the short side in blue, acting as a kind of safety net. The two are designed to work together to create a more balanced journey for you, the investor. And you can see this commitment to balance in the fund's official risk rating too. It's categorized at a risk level of 2, which really just underlines that the goal here is balance, not, high stakes, maximum risk gambling. So how does this actually play out? Well, in a rising market, the long positions are designed to do the heavy lifting, generating those strong gains. The short positions might take a small loss, but the overall result, it's a net positive. The offense is delivering. Okay, but what about in a falling market? This is where the strategy really shows its defensive strength. Sure, your long positions might be down, but the gains from your short positions are designed to kick in and help cushion that fall. The whole idea is to soften the blow compared to a strategy that's only invested for growth. This is that downside protection in action. So we've gone through the mechanics of how it all works, but what does this actually mean for you as an investor? Why does this matter? Let's boil it all down to 3 key benefits. Here are your key takeaways. First up, diversification. This fund diversifies by strategy, not just by owning different stocks. It combines both long and short approaches. Second, downside protection. Those short positions are there to act as a cushion when the market gets volatile. And third, balanced growth. The ultimate goal is to seek that long-term appreciation, but to do it in a way that actively manages the risks along the journey. And listen, this isn't just our take on it. A direct quote from the fund's own investment approach confirms this exact philosophy. The goal is to balance risk and return using a combination of different strategies. So, what's the big takeaway here? In a market that can be so unpredictable, a strategy that is built from the ground up to be balanced, well, it isn't just a nice to have. For a lot of investors out there, it's becoming absolutely essential.
Hey, if you found this explainer helpful, make sure you subscribe for more deep dives into different investment strategies. Thanks so much for watching.